Hey everybody, and welcome back to the Ronnie V Show. PayPal had dropped over 14% after they released their earnings this morning and have rebounded heavily since to being down only 4.5% at close. PayPal had a beat on the top and a miss on the bottoms on their revenue. So they beat their EPS and missed on their revenue. We're going to get into this, and we're going to talk about my valuation analyzer. I already have all the numbers plugged into my valuation analyzer for PayPal, and we're going to get into what prices you should be paying for PayPal and when it's a deal and when it's not a deal. So stick around to the end of the video so we can go through that and you know exactly when you should be a buyer of PayPal. And it might be sooner than you think. So let's get into it. So like I said, PayPal delivered strong third quarter results and boosted their full year guidance. Now, the stock went down for a couple reasons, in my opinion. The two biggest reasons are, one, they missed their revenue, and two, they only grew at 6% year over year. So they missed their revenue estimates, and they only grew 6% year over year from last third quarter to this third quarter. And also, typically with PayPal, you have a 6% growth. You might have like a lower increase in revenue growth, but at the same time, your current neutral FXN is usually going to be higher. So usually they're growing a little lower on the net revenues, but this number is usually 2 to 3 points higher. But we didn't get that this time. We got inline numbers. But let's go through the rest of it and highlight the positives, neutrals, and negatives. So first two negatives right out the rip. Got that out of the way. They missed on revenue, and they missed on their. They didn't miss, but the revenue growth is 6%. Wall Street wants this company getting back to double-digit revenue, and so do I, honestly. But it, in my opinion, might still be a buy, even with all these hiccups along the road. Alex Chriss has been leading the company, has been doing a phenomenal job, in my opinion. And yeah, who doesn't love that Will Ferrell commercial that we keep seeing so much during football, right? So, yeah. So we are raising our full year non-GAAP guidance and are pleased with the strength we are seeing across the business. We've built a solid foundation in this last year that will serve us in the years to come. I already talked about their net revenue not being as great as we thought it would be. Transaction margin dollars up 8%, $3.7 billion. Their GAAP operating income increased 19% to $1.4 billion. That's a plus. Their GAAP operating margin expanded 198 basis points to 17.7%. That's also a plus. And then their GAAP EPS increased 6% to 99 cents. Non-GAAP EPS increased 22 cents to $1.20. So EPS is growing pretty nicely. I think their free cash flows are really exploding, which I really like to see. And you know, the revenue growth isn't growing as fast as I would like it. But we're going to talk about how the free cash flow is greatly increasing year over year, and if that continues to uptrend, I take in consideration EPS and free cash flow a lot more than I do revenue growth, because it's all about valuing a company. And if the revenue growth is, if it stays between 6 and 9%, I'm okay with that, because you're about to see in the numbers I'm about to show you that still really well, and you're still going to get great returns on this company, even at those growth rates. Neutral total payment volume increased 9% to $422.6 billion, 9% FXN. So I don't like that. So you had an increase of 9% in total payment volume, but you only had an increase of 6% on the revenues. That's definitely not something we want to see. If anything, we want to see higher net revenues with lower total payment volume. And that's just because you have higher transactions going through across PayPal. Active accounts increased. Amazing. They're getting back to growth on active accounts and starting to climb those back up, which is what we want to see because those numbers were declining there for a little bit. My favorite, cash flow from operations of $1.6 billion and free cash flow of $1.4 billion. And that is a nice increase year over year on the free cash flow. And they're trailing 12 month, and what they're going to end the FY24 at for free cash flow for the end of this year is going to be a lot nicer than it was last year. And it's going to be looking pretty well. Pretty good. So cash and cash equivalents and investments is up to $16.2 billion, and they return $1.8 billion to stockholders by repurchasing approximately 28 million shares of common stock. So these are the numbers. I'm overall pleased with these numbers and this earnings report. I still think they're on a great trajectory. I would have liked to see net revenues be a little higher, and I would have liked them to not miss on revenue. Just an easy 1-2 right there. But all right, now that we talked about that, I did punch all these numbers into my valuation analyzer. So this is my valuation analyzer. Like I said before, I built this from the ground up. It took me years to build this and perfect and figure out, if it was actually going to work. I back tested it with so many companies. And then I started to invest with this, and it's given me great returns. I've been beating the market for a couple years now, consistently. A couple years being 6+ years now, consistently. With this actual tool, I've been beating the market for about 4+ years now. So it's been it's done very well for me. And the best thing we can have with this valuation analyzer is when we get a 6 for 6 setup. So evaluation score up to 6 is the grading. 6 of 6 obviously being the very best, the creme de la creme for an investing opportunity, and 0 of 6 being watch out. Not saying they're going to go bankrupt, but like the numbers are not lining up whatsoever on a wide variety, I believe, of different things that I look at inside this valuation analyzer. I think I have a wide scope on everything. I don't feel like I need to put anything else in here. I think it's performed really well and is going to continue to perform really well with how I have it set up and how I have it running. So real quick, to label the 6 criteria that go into the score for the valuation analyzer, you have free cash flow yield, you have forward free cash flow yield, current PE, forward PE, PEG ratio, your price to earnings growth ratio. That's in there for your growth companies. And you have basically the rest of this is your discounted free cash flow model. Warren Buffett is all about the discounted free cash flow model, and so am I. That is my number one thing that I'm looking at on here. Everything else over here is gravy on top. Free cash flow is everything for a company, and it's what really drives a company to be successful and to garner a high valuation, in my opinion, and to continue growing and giving back to you, the shareholder, over time. So let's kind of go through this a little bit. We'll be quick with it, but basically you have some basic numbers in here. So it's awesome with this tool because I have it all built out and I have all the equations in here already. So basically every earnings report, I can just come in here, update the numbers, and then it's going to spit out my intrinsic value, my fair value. And it's going to also spit out my intrinsic value or fair value less stock-based compensation. So right here, you can change your free cash flow margin rate for the next 1 to 5 years. So the 10-year analysis. So we had the first 5 years. I have it at 22%, which is what they're doing right now. And I have them getting up to 25% over the last 5 years. And that's just because I see them on this trajectory of continue to increase free cash flow and get better and better. The discounted rate's always going to be 10% on here. your terminal value or your multiple of free cash flow at the end of the 10-year mark, so 2033, is going to be what you believe it to be. Meaning, if this is a high-powered growth company growing high teens to 20% plus growth rate on their revenues, well, then if you think that's going to carry on until 2033, you might assign this a 30 plus PE. But if it's going to be like we have over here, again, these are the numbers that I put in for the growth rates on revenue for PayPal, is going to be, we had 8%, we'll have 8% this year starting out. And then 2025, we're going to have 8, 7, 8, 10, 9, 8, 8, 8, 7%. And I think those are good revenue growth rates. I think they're going to stick around there and then even have the potential to beat it. I can't really see them going lower than 7% revenue growth rates. Just where the world's going, more people, more money, more flowing. This is a world company, not just United States. They're all over. So I think Alex Chriss is putting this company on the right path, and I think they'll actually have the chance to beat these numbers, honestly. So next up, like I said, we were talking about the free cash flow multiple. I assigned a 10, and that's what Warren Buffett and Charlie Munger like to have it as, and they started as a 10. Like I said, I change it around depending on the growth rates of the company and everything. I'm going to be honest, I think this could be a lot higher. I think you put a 15 or 20, maybe even a 25 if they get up to in the teens on revenue growth rates again. But I leave it at 10 because we are 41% current margin of safety. So why would I go higher if we are already 40%, over 40% margin of safety compared to this current stock price of $80.28? To me, I'm just going to leave it. So we have a revenue growth rate. We have our current free cash flow. I think this year with this quarter, this year is going to end at, I think, $7.1 billion in free cash flow, which is a major uptick from last year's free cash flow. Next, we have stock-based compensation. They're getting that under wraps as well with Alex Chriss. They were kind of getting a little crazy with it before Alex Chriss got there. They have $13 billion net cash compared to their net debt. And then they have about 1.012 billion shares on the market right now after they bought back those 780 million or whatever it was. So we have here our free cash flow yield screaming a buy, forward free cash flow yield screaming a buy. Our EPS for this year, our expected EPS for next year, we're under an 18 PE right now, or an 18 PE right now, under a 17 forward PE. And then our PEG ratio is 2 because they only grew 9% year over year on their EPS. Not the greatest. Like I said, not the greatest PEG ratio, but this isn't really a large growth company, so you can't fault them for not having a sub 1 on their PEG ratio. But every other indicator on here is screaming that this company is a buy. Even the free cash flow, the discounted free cash flow model, even the discounted free cash flow model minus the stock-based compensation, which some people don't even do that. It's still screaming a buy right now. You're still getting 26% margin of safety on this company with an intrinsic value or fair value of $109 or an intrinsic value or fair value of $137 for your non-stock-based compensation. So I've been buying this company left and right. It was down at 68. It was down at 54, which is crazy. I mean, crazy amounts of margin of safety, which is basically transfers margin of safety. The lower you buy, it basically transfers into your CAGR you're going to get yearly and the amount of return on investment you're going to get on investing in a company like this. Google's a 6 for 6 as well. I was just screaming about that one before they had earnings, and now they rocketed up after earnings, and it's going to go way higher. Their intrinsic value is like $206, and I've been buying them for like sub 150, just left and right. You know what I mean? So PayPal is going to have the same thing. I think once people digested the earnings, they realized, once maybe they ran it through some discounted free cash flow models, or just, I don't know, realized that this company was in the doghouse for the longest time. And it finally started to get out, and, to miss on revenue and have a 6% year over year growth rate on your revenues isn't the greatest, but it is what it is. I'm not really worried about it. I'm focused on the long term. I'm not going to let these quarterly hiccups derail me from my strategy. This is my investing strategy. This Excel sheet right here is my investing strategy. Also, just having conviction in the company, which I do with PayPal. They're a market leader, and they're going to continue to kill it. And I believe in their CEO fully. Last thing I want to kind of talk about here is kind of this little thing. If you saw this over here, so everybody has, current margin of safety, and you want to buy in DCA on the way down and buy as low as possible, which usually won't get below 50%, but with PayPal it got down to 60%, but the numbers weren't the same at this point. So take that into consideration. They weren't doing $7 billion of free cash flow. So the numbers are always changing. Like I said, things look a lot rosier now than they did, I will say. But so you have your margin of safety, but I don't know if I'm the only person doing this. I know that everybody has their margin of risk with trading and investing and stuff, but I don't know, I might be the only one that's doing the margin of risk overvalued trimming formula. And essentially what I mean by that is, as you can see here, if the numbers were to not change as of today and we got up to $150, I would start to possibly trim my position. Now, I will say the only caveat is, and you would do 10% every time, it got to this number, and then you would get rid of you would be down half your position or whatever, unless it fell back down in here and then you were buying. But I will say the one caveat is, this is very important for something maybe like a Palantir or Tesla. If you want to trim a little bit of that or not, and you want to hold it long term and never sell, that's fine. But with this one specifically with PayPal, I told you there's a 10 terminal value on the multiple free cash flow, and that's so low in my opinion. So if we were to assign maybe like a 20 to 25, so let's just say a 20, you see this drastically goes up. So I honestly wouldn't sell. I would bump it up to a 25, just where I see them going. Maybe a 20. But either way, I wouldn't be selling trimming until we get above 200. Like I said, not every company is like that. There's some companies that I have a terminal value of 25, 30, and I'm like, that's safe for their growth rates. But if it gets there over here, I'm not going to be like, well, I need to put a 50 on there. Like, no, that's not the case, because it's 10 years from now. So, but yeah, guys, that's what I'm kind of seeing with PayPal. That's what I thought about their earnings. That's what I'm seeing on my valuation analyzer. I really hope you enjoyed this video. If you made it to the end, I really appreciate you. Like, subscribe, follow for more. I'm on X. I'm on TradingView. I do investing. I do charting. I have a strategy for investing, which is this, and I have a strategy for trading as well. So if you want to see more, or have any stocks you want me to run through my valuation analyzer, just drop it in the comments below. But thanks, guys, and have a great day.